Understanding liquidity in macro markets is essential for traders aiming to effectively navigate global financial conditions. Liquidity, the ease with which assets can be bought or sold without significantly impacting their price, plays a critical role in shaping market behavior and investor sentiment, particularly in equity and cryptocurrency markets. Firstly, global dollar liquidity is a key driver of financial markets worldwide. Given the dominance of the US dollar as a reserve currency and its role in international trade and finance, the availability of dollars directly influences global asset prices and market stability. Ample dollar liquidity typically supports global growth, reduces market volatility, and encourages risk-taking by investors. Conversely, when dollar liquidity tightens, often due to restrictive monetary policy, balance sheet reductions by the Federal Reserve, or increasing demand for dollars during periods of market stress, global markets can experience significant disruptions and heightened volatility. The repo market is another crucial aspect of market liquidity. The repo market involves short-term borrowing and lending, primarily among financial institutions, using securities like government bonds as collateral. It serves as a fundamental channel for funding and liquidity management in financial markets. When repo market conditions deteriorate, liquidity can rapidly tighten, triggering broader financial stress and market declines. For instance, disruptions in the repo market can lead to higher short-term borrowing costs, reduced financial leverage, and forced asset sales, amplifying volatility across equities and crypto markets. Tightening liquidity conditions matter significantly for equities. As liquidity declines, investors become increasingly risk-averse, withdrawing from riskier assets like stocks, which rely heavily on investor confidence and steady capital flows. Reduced liquidity typically results in larger price swings, diminished market depth, and greater susceptibility to shocks or sudden market sell-offs. Similarly, cryptocurrencies are particularly sensitive to liquidity conditions. Crypto markets, characterized by high volatility and relatively lower liquidity compared to traditional markets, are extremely vulnerable during periods of tightening liquidity. Investors often rapidly withdraw from cryptocurrencies as liquidity dries up, exacerbating price volatility and contributing to steep market declines. Traders who understand the nuances of liquidity, such as monitoring central bank actions, analyzing repo market health, and tracking global dollar conditions, can anticipate significant market moves. By maintaining awareness of liquidity trends, traders can better manage their portfolios, reduce risks during periods of potential liquidity stress, and position themselves advantageously when liquidity conditions improve, thus enhancing their overall trading effectiveness and risk-adjusted returns.